Everyone, we are back, and I am here with Sterling Neblett. How are you, Sterling?
I'm doing great.
Well, great. And we're going to switch gears. We're going to switch gears to investing. Okay, so I am curious, and like I was saying in the introduction today, is I was sitting there at my computer because I was preparing for our talk today, and there are so many terms that are bouncing around with regards to investment. So, can you mention and maybe even define some of the more common terms when it comes to investing?
Sure. So I thought we'd start with stocks.
Okay.
And so when you're buying a stock, you're buying a piece of a company. So let's use Apple, for example.
Right.
So today, if you had, for a little less than $132, you could be an owner of Apple.
Okay.
And that sounds amazing. $132, I can own a piece.
I would love to own Apple.
Right. I mean, so, for $132, you really would be an owner of that company. And you would buy a share of that company, which is considered stock or equities, and you would participate in the revenues and the growth. Hopefully that company, Apple would grow. I'm not saying it will,
Yes.
but hopefully the idea is with time, you buy into good companies and you grow with them. So your $132 could turn into maybe $400, 20 years or down the road.
Okay.
And so, that's this, to put what a stock is simply. A bond, a bond is a loan. So when let's use Apple again, let's say Apple wants to raise capital, they want to raise money, maybe they want to buy another company, maybe they want cash for other purposes, they can issue bonds. So they issue a loan, which you buy. When you're buying a bond, you're lending money to the company. And usually that has a term. So let's just say for this example, a 10-year term, and they pay you interest, each year for that term, and then you get your money back. So that's really, that's what a bond is.
Okay, that makes sense, because I was a little confused with that issue with the bond.
Yeah. So
is there any other terms that you would
Sure. So when most retail investors invest, a lot of times they're not buying individual stocks and bonds, but they are buying them indirectly. So they'll invest in maybe an ETF, an exchange traded fund, or a mutual fund, which you've probably heard of, and maybe you invest in yourself. And what those are is they're a basket of these different securities. So they're a basket of stocks or a basket of bonds. And on the ETF side, they usually follow an index. So your most common index is the S&P 500. Most people have heard, when you hear what is the market doing today, most people are referring to the S&P 500. So that is a basket of 500 stocks. And when you're investing in the S&P 500, which you can do through an ETF, you're investing in those 500 stocks, and your money is going to move with the prices of those 500 stocks.
Oh, I understand.
And then on the flip side, you can have an ETF with bonds. So again, they'll invest in a basket of bonds, and you're going to receive the interest payments and the various terms of those bonds or loans. And then on the mutual fund side, you typically have more active managers. So rather than buying the S&P 500, which is you're going to get the performance of the market, in a mutual fund, you're putting your money with a manager with the idea of they will select individual stocks and hopefully outperform that S&P 500. Maybe that's their objective, is to outperform the S&P 500, or maybe their objective is to have similar performance but with less risk. So these are all measurements you want to look at when you're investing.
I love that. So you're kind of breaking it down into manageable terms. So that's one term, and I'll be the first to admit that confuses me, and I know it's confused some of our viewers that have reached out, is the concept of asset allocation.
Yes.
What does that mean exactly?
Very good question. So asset allocation is essentially you're putting your eggs in multiple baskets.
Okay.
You always
that
hear,
makes sense.
you hear the phrase, you don't want all of your eggs in one basket. And the reason for that is because...
And you agree with that?
I agree completely. And the reason for that is you don't want to when your eggs are in one basket, you're taking a lot more risk. Okay. So what you want to do is you want your eggs in multiple baskets. You want to diversify your risk, which means you may put some money in stocks. You may put a chunk or sliver of your portfolio in large cap stocks. Now keep in mind, in the arena of stocks, there's a lot of subcategories. So you have, large companies, mid-sized companies, small companies, international companies. So you want, money in all of those different subcategories. And then you have the bond side. Well, on the bond side, you have different subcategories as well, and you want to spread your money across. And what that allocation, in determining that allocation, it's really based on your personal goals.
Okay.
If you're close to retirement, let's say you're 5 years from retirement, you can't afford to have as much volatility in your portfolio. You can't afford to have as much risk. So in that case, you typically have more money allocated to, the bond side of things, or lower volatility securities or investments, versus stocks, which tend to be more volatile and higher risk.